In a prior video, I introduced to you these common asset accounts. We actually had a little video for each one of these so you know what these are. But I just wanted to give you this list of asset accounts and note that they are all increased with debits. You got to know these, and we will dig into these one by one a little bit later as we go through the course, but you should already have a general idea of what these accounts are and what they represent. You definitely need to know that they are increased with debits and decreased with credits. These are common contra asset accounts, which I just introduced. Allowance for doubtful accounts, accumulated depreciation. Since they are contra to asset, their rules are exactly opposite. Assets are increased with debits, contra assets are increased with credits. Common liability accounts. I've already introduced these in the course. You need to go back and review that, but just remember these are liabilities that are increased with credits. These are the common equity accounts like capital, common stock, preferred stock, retained earnings. These are all increased with credits, and the revenues and gains are increased with credits. Now those things that work against equity, these are equity accounts, but they actually, by recording debits, they reduce equity. Just like if you had recorded it up here, you'd reduce equity. But this is saying that you have more withdrawals, which means you have less equity. You have more dividends, less equity. More expenses, more losses, less equity. These permanent equity accounts keep a permanent running total of the company's total equity and are not closed at the end of the year. They appear on the balance sheet. All these other below are nominal equity accounts, and they are only temporarily used during a given year and at the end of the year are closed into retained earnings. These top ones appear in the statement of owner's equity or statement of shareholders' equity or statement of retained earnings, and the lower ones appear on the income statement. These are common revenue and gain accounts. Sales revenue, rent revenue, interest revenue, gain on sale. They are all increased with credits, and therefore equity would increase if you credit these. These are common expense accounts, and I know we haven't dug into all these, but you can see almost all of them have the word expense. Be careful though, there is such a thing as a prepaid expense, which is an asset, so don't think that's an expense. But these are all expenses. Cost of goods sold is also an expense. So as you record more debits here, your net income will actually go down and your equity will go down. I realize that was very quick, but I'm telling you, if you can go back and study each of those slides and commit to memory the debit and credit rules that you've seen in that larger diagram, you will just really save yourself a ton of time later on as you try to really understand the process of accounting. So now I've got a bunch of quiz questions for you. If you do well on those, you've got a good head start, and wish you all the best. Good luck.